Murray N. Rothbard's book, The Mystery of Banking, dives deep into the fascinating world of economics, finance, and everything in between. It tackles the money supply, a topic that might seem a bit dry at first glance, but is absolutely crucial to understanding how our modern financial system works. There is a lot more to the money supply than meets the eye. Yes, those seemingly boring figures that come out every Friday and send Wall Street into a frenzy. So let's start with a bit of history. Until the 1970s, during the Keynesian era, the financial pages were all about the GNP, government spending, and fiscal policy. Banks and the money supply? They were pretty much ignored. But then, something changed. Chronic and accelerating inflation plagued the economy, and the Keynesian solutions weren't working. Suddenly, everyone realized that maybe, just maybe, the money supply was a big deal after all. But here's where things get tricky. Have you ever wondered why there are so many definitions of the money supply? M1A, M1B, M2, M3, and all the way up to M8? It's enough to make your head spin. And here's the kicker. Which one is the true money supply? Well, the answer isn't straightforward. Each of these represents different components of the money supply, and economists have been debating for centuries about what should and shouldn't be included. Take bank deposits, for example. Why are they considered part of the money supply? We all know that paper dollars are money, but why are checking accounts also included? After all, they can be redeemed for cash on demand. The answer lies in the fact that banks, in a sense, create money. They take our deposits and lend them out, effectively increasing the money supply. This concept was first recognized in the United States in the early 19th century, much to the chagrin of British economists who were still grappling with the idea. Now, let's talk about the origins of money. Before coins and paper money, there was barter. But barter had its limitations. You had to find someone who wanted what you had and had what you wanted, a double coincidence of wants. And then there was the problem of indivisibility. How do you trade a house for a car or a washing machine? The solution? Money. A commodity that everyone agrees has value and can be used to facilitate trade. Throughout history, many commodities have been used as money. Fish, beaver pelts, tobacco, salt, sugar, cattle, and even cigarettes in German POW camps during World War II. But over time, gold and silver emerged as the dominant forms of money. Why? Because they were in high demand, divisible, portable, and durable. They ticked all the boxes for what makes a good form of money. But here's where things get interesting. The money supply isn't just about the physical currency in circulation. It's also about bank deposits. And this is where fractional reserve banking comes into play. Banks keep only a fraction of their deposits in reserve and lend out the rest. This process creates new money. For example, if you deposit $100 in a bank, the bank might keep $10 in reserve and lend out $90. That $90 becomes new money in the system. Now you might be wondering, isn't this a bit risky? What if everyone wants their money back at once? Well, that's where the concept of a bank run comes in, and it's not just a theoretical concern. Bank runs have happened throughout history, and they can be devastating. They expose the inherent fragility of the fractional reserve system. But here's where central banking comes in. The idea is that a central bank can act as a lender of last resort, providing liquidity to banks during a panic. The Federal Reserve, for example, was created in 1913 to provide a more elastic currency and to serve as a lender of last resort. But central banking also comes with its own set of problems. It can lead to inflation, as the central bank can create new money at will. Speaking of inflation, let's talk about how it works. When the money supply increases, prices tend to rise. This is because there's more money chasing the same amount of goods and services. But here's the kicker. The effects of inflation aren't felt uniformly. Those who get the new money first benefit the most, while those who get it last suffer the most. This is because prices haven't had a chance to adjust yet. The German hyperinflation of the 1920s is a classic example of this. As the government printed more and more money, prices skyrocketed. People rushed to spend their money before it lost even more value. The economy was thrown into chaos, and the German mark became virtually worthless. But inflation isn't just about printing money. It's also about expectations. If people expect prices to rise, they'll adjust their behavior accordingly. They'll spend more and save less, which can lead to even higher prices. This is why controlling inflation is so important. Once inflationary expectations set in, they can be very difficult to reverse. So, what can we do to create a more stable monetary system? Some argue for a return to the gold standard, where the money supply is tied to the amount of gold in circulation. Others advocate for free banking, where banks are free to issue their own currencies. And then there are those who believe in a more radical approach, like abolishing the Federal Reserve and letting the market decide what money should be. Whatever the solution, one thing is clear. The current system is far from perfect. The money supply is a complex and often confusing topic, but it's also incredibly important. By understanding how it works, we can better understand the forces that shape our economy and our lives. This has been a BrightLearn video from BrightLearn.ai on the book The Mystery of Banking by Murray N. Rothbard. Visit BrightLearn.ai for more fascinating videos like this one, and visit naturalnews.com for full editorial coverage and breaking news on critical stories that keep you informed and aware of what's really going on.